Okay, good afternoon, everybody. We're going to go ahead and get started. There are still a few people signing on, which will be just fine. We're going to take care of a few housekeeping details first. My name is Terry Hecker. I'm the Wellness and Benefits Coordinator for MCW. And joining us today, I have Mark Wildeman, who's going to be our facilitator and presenter. He is from Waddell & Reed, and he has done a number of financial wellness sessions for us, so we're excited to have him back. And then we also have Mark Lash, who's our retirement consultant for MCW, joining us as well. Couple of housekeeping items. You are muted upon entry, so you will not be able to talk directly to the presenters and panelists. But what I would ask you to do is any questions that you have, please put them in the Q&A, and then we will address those questions at the end of the session. We're going to go ahead and kick it off, and I'm going to turn this over to Mark. So if you'll give us just one moment, and then he'll get his slides loaded. Okay, Mark, you can take it from here. Mute. Yeah, it looks like we can't hear you, Mark, for some reason.
How's that?
There you go.
How's that?
Perfect.
Okay, it looked like when we came back in that must have muted again, so sorry about that. Good afternoon, everybody. It is great to be with you again. I can't see you, so I'm not sure if there'd be some familiar faces in the group or not, but if you've been to one of my presentations before, thank you for coming back. And if you haven't been in one of these before, I would like to welcome you as well. As we look at the topic of taxes and tax planning. And certainly this is an influential or really an essential part of retirement planning, is to think through what type of tax situation you're going to be in and how current tax laws might affect your situation. So I am going to pull my slides up here, and bear with me just a second. And so I believe now that you should see the presentation that we are going to go through today. Taxes are something that a lot of people have certainly a lot of feelings and emotions about, but there can also be a significant amount of more understanding that people can have. And so my goal here today is to hopefully educate and equip you for some of the tax issues that might affect you as you go into and throughout your retirement. One of the interesting things about taxes is even one of the smartest people that we've had in our history, Albert Einstein, said at one point the hardest thing in the world to understand is the income tax. And that is probably true more so today than it ever has been, because a funny thing about our income tax structure is it tends to not necessarily get easier to understand, but maybe becomes more complex as time goes on. And like I said, what I would like to do today is to help you to at least sift through this a little bit more. The interesting thing about this topic is actually, whether you're aware or not, but the last 2 to 3 years has brought a significant amount of change in the form of 2 specific pieces of legislation that has affected our tax situation. So part of what we're going to do today is look at, we're going to start off by looking through the 1040 tax form and talk through what some of those things means on there. And actually that form did get simpler within the last couple of years, although the supporting documents and all the calculations behind that is still as complex and challenging as ever. And then we're going to talk a little bit later on about strategies and so on in dealing with taxes in retirement. So this is our current tax form for the year 2019, maybe a form that many of you are all too familiar with. And as you look at it, it's maybe painful to see what your tax situation is, but I've told my clients for years that you're not paying taxes if you're not making money. But that doesn't always ease the pain necessarily. But let's walk through this a little bit, especially because it does represent changes that have been made even in the last couple of years. So line one is simple. What money did you make in your wages, your salaries, your tips, etc.? And that is reported to you by a W-2 form. And so that information goes into line one to just simply represent how much money you made at your job. Then the next other couple of lines here get into some other things. There's tax exempt interest. So for instance, if you own a municipal bond, then that is reported to you as income, but it might not necessarily be taxable. But then there can be different types of bonds where some are taxed for federal purposes, but not for state, or vice versa. But it still does get reported and then handled through your tax return as to whether you owe tax on that or not. Qualified dividends, if you have investments that are not held in a tax-protected retirement account, such as a 403B or an IRA or a Roth IRA, then if you hold investments outside of those types of accounts, even though you might not have received the dividends, you had them reinvested back into your portfolio, they still show up on your tax return as a taxable event. A common question might be, well, how much tax do I pay on those dividends? That depends on the holding itself, but for the most part, it does get added to your income as ordinary income, as if you actually made that money as a taxable wage. IRA distributions, this is more for you in retirement. As you start taking money out of your retirement accounts to supplement income, that shows up on here as taxable income. Also in retirement, if you have pensions or annuities that you are receiving money from, that money may or may not be taxable, or it's a combination of both. Some of the money might be coming to you as taxable, some of it might be non-taxable, but that is generally reflected in your 1099 statements that you would get from those organizations that administer those plans. Social Security benefits, I get this question quite a bit, which is how much money am I paying in tax on my Social Security? It depends on your overall situation, but we are going to, if we have time at the end, I want to look at the taxability of your Social Security benefit, because that is something that literally affects almost all of us in retirement. Capital gains here, line number 6, frankly, what that is if you owned an investment, let's say a stock, for instance, you bought it maybe for $5,000, and then over the last year you sold it for $8,000. So there you experienced a capital gain. And as long as you held that investment for more than 12 months, that capital gain for most people is taxed at a 15% level. So if the $3,000 is your taxable gain, you would be paying about $450 in capital gains tax as a result of that. So that would go at this spot within your 1040 form. Then there's a number of other things that can show up as other income. That could be business income, passive or earned or otherwise. So we're not going to go into all those specifics there because there's way too many possibilities there. But that would fall into this area. And as we move on there, we come to, there's adjustments from Schedule 1. So we're not going to go into Schedule 1 because that might get too much into detail, but there can be adjustments to your income because of now a form that we call Schedule 1, and you can look through that on your own. But when you add all this up then in line 8B, you come to your adjusted gross income, which is oftentimes just abbreviated as AGI. AGI is an important number because we're getting close to actually calculating your tax, although we still make an adjustment. But there's a lot of things that are going to be based off of AGI, and actually the taxability of your Social Security takes your AGI into consideration, for instance. So that's an important number that other pieces of information or calculation is based on within your overall tax situation. So once you have your AGI, which you literally could say that's how much money you made this year, but made up from a number of different sources, then the government allows you to take a deduction. A deduction is important because literally a deduction reduces your taxable income, and so it has a very big part in lowering the amount that you pay in taxes. And we're going to get into a little bit of the recent changes that have been made in the difference between standard deductions and itemized deductions. Line number 10, qualified business income. If you're a business owner, there might be other forms or reporting that happens there. We're not going to get into that as much because that might very well may not apply to many of you. So then you add that up to come to your taxable income. So again, this is the income level that your actual tax is based on. So then we go to the top of the next page. So if you do your own taxes, you're familiar with some of the tax tables, and you look that up based on what your number is and whether you're filing a joint return or an individual return. But your tax actually gets determined, again, by whatever is in line 11B, so that you figure out your tax based on the various tax brackets. So that gets filled in here. And if you have children at home and they apply for the tax credit, you get another deduction there, but that deduction is taken right off your taxes. It's not taken off of your tax as a tax deduction for the sake of your income. It actually gets subtracted right off of your tax bill. And so, yes, we spend a lot of money on our children, but the government does allow you to have a significant tax benefit while your children still apply for you to get that benefit. A couple other things going on here, but ultimately you come to your total tax, and then they compare that to what money has been subtracted from your paychecks or your 1099s, which has already been sent in for you to figure out how much money you need to pay them. And there's other things going on here, but a lot of that may not apply to you. And for the sake of time, that's kind of what I wanted to cover within the tax form itself. So the reason that I did that is it's important to kind of understand the flow of how the form handles your various sources of income, how it handles your deduction, whether it's standard or itemized, and then the actual calculation of your paid or your paid due tax amount overall. So that's all we're going to do with the tax form. So now I want to go back to the Tax Cuts and Jobs Act of 2017. That bill was signed into law on December 22nd of that year. And then most provisions were effective immediately right away in January 1st of 2018. And one thing that a lot of people don't know, but a lot of these changes that were a part of that tax law actually will sunset at the end of 2025, where my understanding is then we default back to the way the tax code was in 2026 if no other changes are made. So we're under a new tax code with a decent amount of changes, but it is possible that we could be going back to the old way beginning in your tax year 2026. So keep that in mind, but obviously a lot can happen between now and then. This tax legislation really impacted both individual taxpayers and especially businesses. I don't want to get too much into this, but it was probably, if I'm being honest, more friendly to businesses than individuals, because businesses were paying about 35% of their income was being taxed or paid in tax, and they cut that down to 21%. And so that was a big, big change for them, but there's still beneficial things that individual taxpayers got out of it as well. This is being one of them, where this is a list of tax bracket levels And we'll talk more about the brackets and how they work in just a minute. But in a nutshell, before the tax legislation was passed, the top line or the before line shows all of the different tax percentage brackets that were out there. And then you can see how some of those changes happen. So we kept the 10% tax bracket, but the 15% went down to 12, and you can see the rest of the progression there. So the tax legislation was also friendly to individual taxpayers for the most part when it comes to your tax bracket. Going further with tax brackets, I've included the actual brackets for how the tax code has shaken out. I'm going to skip to the next slide here because many of you are, oftentimes in a meeting like this, many of you are married. So commonly people are married and filing a joint tax return. So if we said, for instance, that this is going to be more a discussion about how the tax brackets work and not necessarily as much about the difference with the new tax legislation, but with the after reform part, if your joint adjusted gross income is, let's say, $100,000, you would fall into this tax bracket. But this is a laddered system. So if your adjusted gross income is $100,000, the first $19,000 of that is at the 10% level. And then the next, what would that be? 57,000 of that approximately would be at the 12% level. And so then the rest of it would be at the 22% level. This is important to identify how this works, especially in retirement, because if you're going into retirement, if you can possibly stay out of the jump from this level to this level, again, because the brackets are progressive, meaning your money still started, some of it's at 10%, some of it's at 12%. But if you can stay at all out of this, or at least as much out of this level as you can from the 77,000 to 165,000, that's a big jump going from 12% to 22%. In fact, that's a bigger jump than any one of these steps here. But this can make a big difference. If you fall pretty deep into the 22% tax bracket, then you definitely notice a big difference there as you go deeper into this bracket. But that's essentially how that works. Deductions and exemptions. So we already talked about what adjusted gross income is by looking at the actual tax return. But one of the big pieces that came out of the recent legislation was standard deductions versus itemized deductions, which we'll get into. And then you used to be able to get an exemption, personal exemption for you and your spouse and for dependents at home and so on. They literally eliminated that as part of the 2017 Act. So we don't calculate the exemptions anymore, but what that did is it significantly bumped up the standard deduction level. So you didn't necessarily lose anything, they just made it emphasize more into a different area, being the standard deduction and not so much with exemptions anymore. So what they did is they took that standard deduction and made it quite a bit higher. If you're married filing a joint return, you used to get a standard deduction of $12,700, but after the legislation was passed, you now bump up to $24,000. So if you're married filing a joint return, this has gone up this year to $24,800, I believe it is, but we're looking at the data in the first year. So they literally almost doubled your standard deduction. And again, the deduction is the amount of money that is subtracted from your total income, but before your tax is calculated. So the bigger your deduction is, the less tax that you actually pay. Now, many of you, before this legislation was passed, were taking an itemized deduction. So what is an itemized deduction? Well, there's many things that qualified and still do qualify for an itemized deduction. So for instance, The interest that you pay on your mortgage over the course of a year gets calculated in your itemized deduction. The amount of property taxes that you pay gets qualified as an itemized deduction. Charitable giving generally that you do gets added to your itemized deduction. So those are some of the big ones. There are others, including medical expenses and so on. But if you've itemized before, you generally know what I'm talking about. And before the tax legislation, a lot of people would take the itemized deduction because it was over the $12,700. But now with the standard deduction being $24,000, if your itemized deductions don't exceed the $24,000 in this individual tax year, then you would you just take the standard deduction. So that was a bit of a change there, and it's pretty significant because a lot of people did itemize on their taxes, but now they don't need to because the standard deduction is actually higher than their itemized deduction. The biggest goal here is to declare the highest deduction available to you because that's going to lower your income for the sake of your tax calculation. So it is important to be familiar with this and even manage towards it. Okay, this is more information. I already mentioned the standard deduction, some of the things like mortgage interest, charitable contributions, and so on that do apply. This is an individual that used to, for example, that used to itemize, and state and local taxes also can be itemized as a deduction. So this individual pays $5,000 in state and local taxes. They have $10,000 of interest off of their mortgage. Your principal doesn't count, only the interest off of your payments counts. So that came to $10,000, and then they also donated $3,000. So their total itemized deductions came to $18,000. In 2017, that was greater than the standard deduction, so they took the itemized deduction. In 2018, with the standard deduction being $24,000, now they're taking the standard deduction. So that's the difference there. Other important changes under the new tax law, if you are itemizing, there is a limit on the state and local tax deduction. There's been a modification with the home mortgage deduction, other things moving down, the alternative minimum tax, the increase. So some of these things are also in there, but to go into detail within each one of these, we don't have that much time today to cover all of that, but at least you see what some of the categories are on the changes that happened a couple of years ago. Other permanent changes, charitable giving deduction has been increased. Alimony deduction was eliminated after the end of 2018. And then also the 20% deduction for pass-through businesses. And for business owners, that's an issue, but again, that might not apply to many of you, so we'll move on there. Also, many of you are aware that when you pass away and your estate, which is all of your investments and your cash at the bank, your cars, your home, and all of the things that you own, pass on to your beneficiaries. And so a lot of people ask how much tax they're going to have to, or your beneficiaries are going to have to pay. Well, it depends on the size of your estate. So if your estate, and this even includes proceeds from your life insurance policies, which can really jack up the size of your estate depending on what type and what size of policy you have. But up until this tax legislation was passed, the first $5.6 million of your estate were actually exempt from taxes. So if your estate was $1.5 million, which was well below the $5.6 million, then your estate would not have to pay any estate taxes. And actually what they did is they bumped this up even more to be $11.2 million in 2018. So they almost, well, they basically doubled, I should say, this tax exemption. And a lot of people look at this and say, why are we even covering this? Because that's not going to apply to me because the exemption is so big now. I've been doing this for 20 years, and when I started in this industry, the estate tax exemption was only $600,000. So when you add in the value of your home, your investments, your cash assets, your cars, and again, proceeds from your life insurance policy, it used to be that the estate tax affected a whole lot of people, but now since the exemption is so high, it's not affecting that many people. So then you might be wondering, why am I covering this? Well, again, remember that when this tax law sunsets, then in 2026, we go back to the $5.6 million plus an adjustment for inflation. But I also won't be surprised if we don't move more towards the 600,000 at some point, again, to help the government to fund their operations. So we've had a big variance in what this exemption is, and time will only tell where we end up with that in the future. Unified tax credit, oftentimes people are familiar with this because if you gift money to your kids, in any given year, you can gift up to $15,000, which is a heightened amount, and then that is not subject to the gift tax, and the gift tax has to be paid by the giver, not by the receiver. And so we've seen this gift tax amount allowable been going up a decent amount over the years as well. Okay, so that was pretty basic as an overview, covering that tax act that was passed in late 2017 and put into effect in 2018. But then more recently, we had another pretty sweeping change in the tax environment, especially as it relates to your retirement. And this was passed on December 20th of last year and put into effect on January 1st, and it's called the SECURE Act, which stands for Setting Every Community Up for Retirement Enhancement. We're going to talk a little bit about this as well, especially because this is much newer. So why does this matter to you? It does impact your retirement planning options. It has key retirement planning focal points. So many of you are familiar with required minimum distributions, and we've had some changes there in terms of being able to contribute to a traditional IRA and being eligible for that. We had some changes there, part-time worker 401k participation, lifetime income through employer-sponsored plans, withdrawals for birth adoption expenses, and also stretch IRA elimination has been a big topic in there as well. So this has the most immediate impact on those who are nearing retirement because these things are definitely going to affect you. So one of the more notable issues is many of you are aware of required minimum distribution. You might not necessarily know how it all works exactly, but many people are aware that as you go into retirement, your 403B accounts, your 401k accounts, your traditional IRA accounts, before when you turned, the year that you turned 70 and a half, you had to be taking money out of those accounts whether you wanted to or not. Why is that? Well, basically, the longer your money stays in those tax-protected retirement accounts, the less revenue that the government gets. And so they've, in their minds, figured they've waited long enough. So whether you want to or not, at age 70 and a half, you had to start taking money out. To give you an idea, the first year, about 3.6% of your account was calculated, and then you had to take that out and declare it as taxable income. So what they did is they changed that from 70 and a half to 72 now. So they gave you another, well, a year or two, depending on where your birthday falls during the year. But now the year that you turn age 72, you have to be taking money out of your retirement accounts, whether you want it or not. By the way, this does not affect your Roth IRAs if you happen to own those. Those don't have a required minimum distribution on them because they're not taxable distributions. So keep that in mind as well. But Again, one of the bigger pieces of this legislation was the change of the required minimum distribution age. Also, if you are still working, you can still contribute to a traditional IRA beyond this point as well. That was a bit of a difference there too, if that applies for you. 401ks for part-time employees basically made it mandatory that you be eligible within a 401k even though you're part-time, meeting these requirements as well. And also, if you are taking money out of your retirement accounts but using it for birth or adoption expenses, the first $5,000, there would not be a penalty on that, where normally if you take money out of those accounts before the age 59 and a half, you would have to pay a penalty. So that was in that legislation as well. In my opinion, then this next part gets into probably the second most important part of this legislation. And this gets a little bit technical, but let me explain it this way. Let's say that your parents or one of your parents had money in a traditional IRA and there was $100,000 in there and then they passed away. You were listed as the primary beneficiary on that account when they passed away. And so you now get that money, that $100,000 that's in the IRA. However, one of your options is you can take that money out, have it all pulled out of the IRA, which sounds great until you think through the fact that now you're going to add $100,000 to your taxable income that year, which is probably going to push you up at least one tax bracket, if not two, depending on your own tax situation. So there's this concept of the stretch IRA, and before the legislation was passed, one of the other options that you had was to take that $100,000 that was in your parents, one of your parents' IRAs, you could put that into what we call a beneficiary IRA. The movement of that $100,000 from your parents' IRA into your beneficiary IRA would then be a non-taxable event. So you're maintaining the tax protection on the $100,000 by not taking that distribution, but instead transferring it to a beneficiary IRA. Then from that point on, regardless of your age, you were then required to take out a little bit of money each year, but it was based on your life expectancy. And so it would be a pretty small chunk if you're a younger person and you inherited that money that way, so that you're slowly then taking money out, but it is at an increasing level for the rest of your life. But then you can spread the tax burden out over 20, 25, 30, 35 years instead of having to pay all the tax on that money in just 1 year. So that's the way that things used to be. And they called that concept a stretch IRA. You're stretching your tax burden out over many years. I think what happened there is now we were starting to see second, third, fourth generations of this IRA money getting passed on and on and on, and then the IRS frankly never gets their money. So what they did is, instead of stretching that out each year for the rest of your life if you inherit that money, now what you would need to do is, from the time that you receive that money, you can still put it into a beneficiary IRA, but now you have to have that beneficiary IRA emptied out within 10 years. There's a number of twists and turns to this, but I'm just going to give you a general overview of this. So within 10 years, you have to have taken that $100,000 out. They really don't even define how much money you have to take out each year. You could be taking zero, but then in the 10th year, you'd have to take out the full amount of money, which again, now you've created an even bigger tax situation for yourself, because over 10 years, the money has probably grown depending on the investments inside of the IRA. So what I tell people is, if you get money like this now, put it in the beneficiary IRA, but then take it out probably in equal payments over the next 10 years to spread that out. But again, you're going to be paying more in taxes this way because you got to get that money out in 10 years instead of over the rest of your life. Okay. So basically with that, we talked about the general tax code by looking at the 1040 form. We talked about the tax legislation passed at the end of 2017. And then we also briefly covered the Secure Act, which is going to affect a lot of people going into retirement as it relates to required minimum distribution and what age you have to take it, but also if you are to either inherit or be passing money on to your beneficiaries with your retirement accounts as well. So my suggested direction for you out of this is, be familiar with these things and understand the financial impact that it has on you, especially as you do your retirement planning. Retirement planning is a very complex and broad scope type concept because retirement planning, last week we talked about making your Medicare decision, which is a huge part of your strategy. Social Security, even though we've had some reforms within the Social Security system within the last couple of years, there's still some very important decisions to be made there. Now we're looking at tax issues. That doesn't even cover what is your money doing, how is it growing depending on your investments and what your money is in, what your money should be in throughout retirement is another piece of this. And then also estate planning, thinking about how this is going to get passed on to your beneficiaries in the most effective and efficient ways. I talk to my clients that I try and do two things as I work with them as they make that transition from their working years to their retirement years is to retire confidently and also comfortably. Confidently meaning you've made the right decisions, you've taken all these variables into consideration, but then also comfortably, did we do the right things and also figure out how much money you can really plan on to do the things that you want to do and make your money last the rest of your life. So all of this covers quite a bit of stuff. So reevaluating your planning strategies as things change and as they have changed is very important. I am not a licensed CPA, so I'm not an official tax advisor. My goal today was to inform you of the tax laws and educate you, but I do certainly invite you or encourage you to meet with a CPA on a lot of these things as it relates to your tax situation, and then obviously thoroughly review your planning documents. So we're going to go into questions here. I think we'll do it that way. And if we have some time at the end yet after questions as well, I can talk about the taxability of your Social Security, but I don't want to do that if that means that some of your questions go unanswered. So I'll still leave that in here as a possible thing for us to talk about, but let's address your questions first, and then we can go from there.
Thanks, Mark. We do have a couple of questions. So the first one is asking, what about existing beneficiary IRAs?
Yes, good question. And part of this is tax legislation gets passed, and then we also go through a period of time where we find out how they're going to enact this thing. But my understanding is if you had a beneficiary IRA before the legislation was passed, then you would be grandfathered in as far as continuing to take distributions the way that you have been, instead of all of a sudden turning on the 10-year rule. So that's my understanding at this point, but part of that is we also have to see, they pass the legislation, we see how they implement it, and then they might come back with other rulings in addition to the tax legislation, and that's where I feel like I can't fully give you an answer on that, but for the most part, the IRS is friendly to things like that, where if it was done that way before, they'll allow you to continue to do it that way until we learn otherwise. So I'm saying, yes, I think that you'll continue the way that you are, but I also am not going to say that I see that not subject to change yet.
Okay, thank you for that. And then we have one other question so far, and that is, please review how many hours one can work in retirement versus the ramifications. So I don't know if that's related to Social Security, maybe income.
That's my initial thought, is that would be related to your Social Security. So I'll answer it that way, hopefully touching on what the question is getting at. But that's probably the best thing I can think of there. So if your full retirement age with Social Security for many people now is age 67, but that depends on what age you're born. But for the sake of the answer to this question, I'm going to assume that somebody's full retirement age for their Social Security benefit is age 67. You can start drawing Social Security, as many people know, already at age 62, but it would be at about a 25% reduction in benefit by taking it 5 years earlier than your full retirement age. But the reason I'm pointing that out is you can be drawing your Social Security between age 62 and 67, but if you're still working on top of that, then it's not the number of hours, it's the dollar amount of earnings that you can have before they start withholding your Social Security benefit. Now, this is only the period of time between age 62 and your full retirement age. Once you're past the full retirement age, you can make as much money as you want. You can make $1 million a year, and it won't affect your Social Security benefit that you'd be drawing at all. So I'm only talking about drawing your Social Security before your full retirement age, and that's where this would apply. I don't have the exact number. I always can't remember if it's in the 17,000 range or the 19,000 range. I think it's about $17,600 that you can make then between age 62 and 67. But if you make over that amount, that's when they will start withholding your benefit. And up until $43,000, the amount of benefit that they withhold is for every $2 that you're over that 17,600 number, if I'm correct in that. Every $2 that you're over that, they withhold $1 of your Social Security benefit. So they don't care how many hours you're working there. It's more about how much money you're earning over that level, and then they start withholding your benefit. But then once you get to be full retirement age, then that's off the table. It doesn't matter how much money you're making.
So Mark, I think the question was kind of in two different directions here for the hours working. One was based on Social Security, and then the other part for the ramifications of hours worked was with regards to 403B plans. So I think that was maybe going towards RMDs and working or not working and required RMDs.
Okay.
So I don't know if you can maybe touch base on taking out, if you're still working or not working, when the RMDs have to kick in. And then also you mentioned they're not required if you have a Roth IRA, but I think there's some variances because we have Roth in our 403B plan at the medical college. I think there's some variances to
Correct.
the RMD rule on that as well.
So generally the way that the IRS works is if you're working past the RMD age, which is now age 72, then the question is whether you are subject to be taking RMDs, or if you're working, then that can be waived. I want to say, and I'll check and verify this, and I can send Terry an email. But I believe that if you're 30 hours or more a week and you're working past the age of 72, then your RMD requirement would be waived yet. The thinking there is, why should you have to take money out of your retirement accounts while you're still working and paying taxes along those lines and really penalize? I mean, generally they don't want to penalize you for working later in life and only encourage you to do that if that's what you so choose to do. So I want to say that if you're full-time, which would be 30 hours or more after the age of 72, you're still working, then I believe that your RMD would be waived, but I'll clarify that in an email, and I think that Terry can send that out to you.
That sounds good, Mark. I'm sure, that's a question for many people that are listening and joining us and watching today. Another question, with so many frequent changes in tax laws, do you have any recommendations on traditional versus Roth accounts in order to minimize overall tax liability if you're planning to retire early?
Yeah, so if you're planning on retiring early, to me, in my mind, what that means is maybe around age 60, perhaps. For some people, maybe it's a lot earlier than that. But actually, Terry, I'm going to ask you to read the question one more time because I want to make sure that I'm addressing it as best I can.
Sure. With so many frequent changes in tax laws, do you have any recommendations on traditional versus Roth accounts in order to minimize overall tax liability if planning to retire early?
Okay. So many of you know that the difference between a traditional type retirement account versus a Roth type retirement account, and that normally is associated with IRAs, but at the medical college, you have both of those available inside your 403B as well, which I think is an excellent option they're providing you. But the difference there is with the traditional route, you're generally getting the tax benefit up front because you're putting in before tax money, which lowers your taxable income in the year that you put it in there, so that you're getting the tax benefit up front. But then when you take the money out at retirement, then that money is 100% taxable, most likely. The Roth is reverse, where your contributions to the Roth don't lower your taxable income, so you're not getting a tax break at that point. But no matter what that money grows to over time, your withdrawals out of the Roth are tax-free then. So you're just flip-flopping the tax benefit there. I tell people with Roth IRAs, whether you're retiring early or later, the big key with the Roth, yeah, the amount of money that you get in there is important, but what's equally as important, if not more so, is the amount of time that your money can be in the Roth. So if I take that to an extreme, if a 22-year-old comes to me and says, should I be doing the traditional route where I get the tax benefit up front as opposed to the Roth where the tax benefit's on the back end? A 22-year-old might have literally 60 years for that money to be growing in the Roth. That's a no-brainer for that person because it's not so much the money going in, it's the amount of time for you to grow that money and still have it, all of its growth be 100% tax-free. That's a no-brainer in my mind. But now when we come back to maybe somebody who is retiring early, that's a little bit of a hard question to answer because it depends on your overall tax situation. Are there going to be other forms of income? What is your Social Security situation going to be like? And having all of those variables play into that decision. But I leave you with the general idea that utilizing, I've had some people come in, even they're still working in their mid to late 60s, and they're asking me that same question, should I be contributing to the Roth or the traditional IRA? Well, the Roth is less attractive if we might be pulling money out of the Roth within 2 to 3 years. where that money hasn't had much time to grow. And so that's an entirely different situation than if you're really pretty close to when you might be needing to draw money out. Well, then you might as well take advantage of the traditional route that gives you the immediate tax advantage. So it's hard for me to go farther than that because I'd have to know your individual situation, and I would even work with my clients where we build a financial plan and we can run these scenarios. Is it better to put money into a Roth or a traditional route? And then the software figures out all of the implications of that to help make the decision even easier. But again, not knowing your situation, that's probably as far as I can go with that. The general idea that if your money can be in the Roth for a long period of time, and you're investing into investments that maybe have a 6, 7, 8% growth rate, and doesn't make sense to put money into a Roth if inside the Roth it's just going to be in cash, because if it's not growing at all, you're not getting a tax advantage there. So if you're remaining reasonably on the aggressive side with your holdings, that helps the Roth to pay off too, because you're growing all that tax-free money as long as the investments are cooperative with you.
Okay, looks like there's one last question here, and it's related to the gift tax.
Yeah.
So the question is, this is about the gift tax. So your parents can gift $15,000 a year. Is that a total for the year? In other words, if you have 4 children, can they gift each child $15,000?
The answer to that is yes. And actually what you can do there is each child can receive $30,000 because the gift can be, one gift can be coming from mom and one gift can be coming from dad. So actually in the case of 4 children, the parents can gift then $30,000 each. So that's $120,000 that they can gift to 4 people without being subject to the gift tax. And actually, if those kids then are older and maybe they're married as well, then actually dad can give a gift to the child, dad can give a gift to the spouse, mom can give a gift to the child, mom can give a gift to the spouse. So then actually taking for each child in that case, $15,000 times 4 in order to be $60,000 per year. So I'm extending that, but in a lot of, if there are 2 parents involved, then each one of them can give the gift, that gift per year then.
Okay, and then there is another comment that, and this might be related to the amount of time you can work and Social Security and the RMDs that Mark had mentioned, you have mentioned. It says one of your 401k slides mentioned 500 hours. So I don't know if that's related to the question.
Oh, okay. Here it is. Okay, so that has to do then, that's not about RMDs. That's basically where the government is mandating that business make their 401ks available to part-time employees, where before the companies could decide to exempt them. So I'm glad that that's pointed out, if that's what the original question was. So this isn't about RMDs. Before, the companies could exempt part-time employees, but now the government is pushing that a little bit and forcing them to make part-time employees, at least some of them, eligible. But the way they're eligible is if they're working $500 per year for 3 consecutive years, and they can still mandate that they have to be age 21 by the end of those 3 years. And then you have the $1,000 or 1,000 hours per year. That's the way the legislation was before. So they took that a step further and at least made some more part-time employees have to be eligible for participation in the 401ks, where before they might have been excluded.
And then we have just a last comment. It says, thank you, great info and insights. So appreciate
Oh,
all the insights. I think that covers all of the questions. I don't know if you have any last finishing remarks.
yeah, I have my contact information on the last slide here. And so if you have further questions, I've gotten some questions in follow-up to the Medicare presentation. So I want you to have my email address and my phone number. That's my direct office number. Feel free to give me a call at any time or shoot me an email with other questions or things that you might need clarified. There are also, out of these presentations, many people that want to come in and have a consultation. And what I do there is I give you, depending on the topic you're interested in, is we'll focus on that topic and specifically look at your Medicare situation or your tax situation either now or what it might be in retirement. And I'll talk through a lot of that and basically give you more helpful information as it's specific to your situation. And a lot of people think, well, he wants me to come in he's going to sell me a mutual fund and so on. That's not the type of conversation that we have. I give you a consultation where, frankly, I give you probably some more free information and so on. Oftentimes, out of that conversation, people have—
Mark, I think you're cutting out on your audio.
But that's not the conversation that you want to have. We'll cover what you want to cover, and then I'll thank you for coming in and send you on your way. I've been doing this 21 years. People don't become my clients because I corner them into conversations. They become my clients because it makes based on these conversations. But many people just come in and have that talk, and then I send them on their way, and they're more educated than me. So feel free to—
I'm gonna just jump in here since it looks like we lost you, Mark.
For your time and attention today. Hopefully this was helpful to equip a little bit more, and we really enjoyed the opportunity.
Okay, it looks like you cut out a little bit there at the end, so I'm not sure what happened. But we'll just leave it that if anybody would like to contact you, you've mentioned before you've offered the consultations.
Actually, I'm back.
Oh.
I think my my AirPod ran out of battery on the one side, so I just put the other one in. I'm sorry. I didn't realize that had happened. I apologize.
That's okay. If you just want to mention when they come in for a consultation quickly how that works, and then we'll close it out.
Okay. So my main purpose is if you want to come and see me and talk about your individual situation, and this is the only thing I focus on is whatever you want to talk about. So if you want to talk about taxes, Medicare, Social Security, those types of topics, I'll give you an evaluation of your situation within each of those areas. And if that's as far as you want to go, then I thank you for coming in. I give you some information and you go on your way, hopefully better educated to make those decisions. Some people then take that further and they want me to maybe look at this investment or, do a lot of things that I do with clients. But I let you guide that direction, and I only go there if that's where you want to go. But I've been doing this 21 years. People don't become my clients because I corner them into certain situations and pressure them. That's not my style at all. I educate you primarily. If you want the conversation to go further, I'm happy to do that, but you drive that car, I don't. So that makes it just a real easy environment for you to learn, and if you want to take it further, great. If not, then I just thank you for coming in.
Thanks for clarifying, Mark, and could hear you loud and clear, so all good. We're going to close it out today. And I just want to remind everyone, we will be working on scheduling some more financial wellness programming. I would encourage you to watch the wellness newsletter or also go out on the wellness events calendar as they are made available. You can sign up for those sessions as well. We're planning some things for September and going on for the rest of the year. So appreciate your attendance today. And any feedback you have, we're welcome, you're welcome to share. You can email wellness@mcw.edu. And have a wonderful afternoon.
Thank you.